What's going on, everybody? This is Coach Wade, and today I want to talk about one of the most important investing lessons you'll ever learn: why time in the market beats timing the market. Now, if you ever watched the financial news, you've probably heard people asking questions like, is now a time to invest? Should I wait until the market goes down? Should I sell because the market is falling? Those are honest questions, but they're based on one big assumption: that someone can consistently predict what the market is going to do next. The truth is, nobody knows with certainty what the market is going to do tomorrow. Not me, not the financial news, not the so-called market experts, not even professional investors. If they did, everyone would be wealthy. But that's not how investing works. Let's talk about what timing the market really means. Timing the market is trying to guess the perfect time to buy investments and then trying to guess the perfect time to sell them. The goal is simple: buy low, sell high. Sounds easy, doesn't it? The problem is, you have to be right twice. You have to know exactly when to get in, and you have to know exactly when to get out. That's incredibly difficult. In fact, many people who try to time the market end up doing the exact opposite. They buy when everyone is excited and prices are already high. Then when the market drops, they get nervous, they panic, and they sell after prices have already fallen. In other words, they buy high and sell low. That's not investing. That's reacting to emotions. Now let's talk about what I believe is a much better approach: time in the market. Time in the market simply means staying invested for the long term. Instead of trying to predict every market move, you commit to investing consistently over many years. You allow time to do the heavy lifting. Because here's what history has shown us: the stock market has experienced recessions, inflation, wars, political uncertainty, financial crisis, global pandemics, and countless other challenges. Yet, over long periods of time, the market has repeatedly recovered and continued growing. Now, does that mean the market always goes up? Absolutely not. There'll be bad years. There'll be corrections. There'll even be bear markets. That's part of investing. Volatility isn't something that's broken. It's part of the process. One of my favorite sayings is this: volatility is the admission price for long-term growth. If you want the opportunity for long-term market growth, you have to accept that there will be short-term ups and downs. Now, let me ask you a question. Have you ever planted a garden? You don't dig up the seeds every week to see if they're growing. You plant them, you water them, you take care of them, and you give them time. Investing works much the same way. You invest, you stay consistent, and you give your investments time to grow. One of the biggest mistakes I see people make is allowing fear to control their financial decisions. When the market is making new highs, everyone wants to invest. But when the market declines, people suddenly become afraid. Ironically, market declines are often when investments become less expensive. Think about it. If you enjoy buying clothes when they're on sale or buying a television when it's discounted, why would you panic when investments go on sale? Yet that's exactly what many investors do. Instead of seeing opportunity, they see fear. That's why having a long-term plan is so important. As I teach in the 7 stages to financial independence, investing belongs in stage 4, the wealth building zone. By the time you reach stage 4, you've already built your emergency fund, you've eliminated your consumer debt, you've established financial security. Now, you begin investing consistently without worrying that you'll need to sell your investments every time life throws you a curveball. I encourage people to work toward investing 15% of their household income for retirement. Not because I'm trying to predict what the market will do next, but because I believe consistency over decades is one of the greatest wealth building strategies available. Here's another reason time matters. Some of the market biggest gains often happen shortly after some of the biggest declines. If you're sitting on the sidelines waiting for the perfect time, or if you sell during a downturn, you risk missing some of the strongest recovery days. And missing just a handful of those days over a lifetime can make a significant difference in your long-term results. That's why disciplined investors stay focused on their plan instead of trying to predict tomorrow's headlines. Here's what I want you to remember. Successful investing isn't about being the smartest person in the room. It's about being one of the most disciplined. It's about continuing to invest when everyone else is excited, continuing to invest when everyone else is nervous, and continuing to invest when the headlines make it tempting to quit. Because wealth is usually built quietly, not through dramatic decisions, but through consistent decisions, month after month, year after year, decade after decade. So if you're waiting for the perfect time to invest, let me encourage you. The perfect time rarely announces itself. The better strategy is to have a plan, invest consistently, stay diversified, and allow time to become your greatest financial partner. I'm Coach Wade, and I believe one of the biggest advantages an investor can have isn't predicting the future. It's having the patience to stay invested while the future unfolds. Remember, time in the market has historically rewarded disciplined investors far more often than trying to time the market. Stay focused, stay consistent, trust the process, and let time work for you. I'll see you in the next lesson.